Bath & Body Works is down almost 50% in the past year and reached a 52-week low of $14 per share in the past month. The main reason for this drop in price was their last earnings report. Let's see if this is a good opportunity to buy the company by looking at the fundamentals and running a DCF model to estimate the intrinsic value of the company and potential future returns. On paper, this company looks really cheap, around 5 to 6 times earnings, and the cash flow yield looks almost absurd. So the question is simple: what happened this quarter and what are they guiding for, and is this actually value or a value trap? Most people in the US know Bath & Body Works. They sell fragrance products, candles, soaps, lotion, shampoos. Basically things that smell good. It's a well-known brand and historically a very profitable one. If you pull out a long-term financial chart, 10 years like we have here, you'll notice the revenue and margin profile looks like it changes companies around 2020. That's because it kind of does. Bath & Body Works used to be part of L Brands, which also included Victoria's Secret. After the split, the financials from 2020 onward represent just Bath & Body Works, and as you can see, revenue has been decreasing since 2020, and it is currently at $7.3 billion. Analysts are expecting very little profit growth as they have revenue decreasing to $7.2 billion this year and then grow to $8.6 by 2030. Profit has also decreased since 2021, from $844 million to $699 currently. And margins have also compressed from around 13% to 9%. And you might look further back and think, well, margins were around the same then too. But back then, those numbers included Victoria's Secret, which is a lower margin business than Bath & Body Works. So during the 2010s, the Bath & Body Works segment likely had higher operating margins than what the company is generating today as a standalone business. So the margin compression is real. On top of that, they have reasonably significant amount of debt, roughly $4.8 billion, which is pretty meaningful, especially when the market cap is 3.8. So they have more debt than market cap. So why are investors tempted? They have a significant amount of free cash flow, currently at $946 million. They are using this free cash flow to return back to shareholder in multiple ways. Number one is buying back share. This is very important for investors because you share the profits with less people and you own more of the company basically by doing nothing. They are also paying a good dividend, which has a yield of 4.25%, and the payout ratio, which is what percentage of their profit is used to pay the dividend, is 24%, which is quite low. Moreover, they are trading at a price to free cash flow of 4, which is extremely cheap. But in order to calculate the intrinsic value of the company and determine potential future returns, I use my spreadsheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $17 per share, middle 28, and high 42. And because the stock is trading at around $19 per share, this means that if my low assumptions occur, you would get an 8% annual return on your money, middle 19%, and high 29%, which are actually amazing returns considering how conservative my assumptions were. For my low assumptions, I assume negative 2% annual revenue growth, middle 0%, and high 2%. I assume the profit margin and free cash flow margin between 7 and 11%, and I assign a multiple at the end of the 7 years of 6, 8, and 10. And I also left the share outstanding change the same. And if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. And if they manage to maintain the same level of free cash flow, this could be a great investment. The main question is, can they maintain it? Because this quarter was ugly. Sales were down year over year. Margins were down significantly year over year. And keep in mind, sales were down even while they've been increasing store count. That's not what you want to see. Their guidance for the fourth quarter was disappointing. They're guiding for net sales to be down high single digits. They cited consumer sentiment weighing on purchase intent and described the holiday environment as highly competitive. And for a retailer like this, the holiday quarter is the most important quarter of the year. That's when a lot of these businesses make the bulk of their profits. On the call, they also talked about losing newer, younger customers. That roughly aligns with the general perception of the brand. It tends to skew more toward a middle-aged or older demographic, primarily female. It's also worth noting they had a new CEO come in around the middle of the year, and this earnings report was his full first quarter leading the company. It's not uncommon for a new CEO to come in and underpromise early, reset expectations lower so future comparisons look better. One potential positive is that they're expanding into marketplaces, specifically Amazon, which they expect to go live in the first half of 2026. They also mentioned cost savings and optimization. And for a company trading at a mid-single-digit earnings multiple with a very high free cash flow yield, those kinds of levers matter. In conclusion, while I believe the amount of free cash flow that they are going to return to shareholders is going to be very attractive, the bad balance sheet and the uncertainty of the direction of this company, I will pass on the stock for now and add it to my watch list. You can make a lot of money from companies like this, but there is a lot of risk in my opinion at the moment, and I see better opportunities in the market. Lastly, if you want a discount on stockanalysis.com, the best place for stock data, grab my code in the description. I hope you found this video valuable. Let me know what you think about Bath & Body Works in the comments, and I'll see you in the next one.